Good morning, everybody. This is Tim Melvin down here in Central Florida coming to you. I was going to start to complain about the weather because it's really only going to be about 70 degrees today. And it's for us, that's a little brisk outside. And I started to make some comments on it, but then my daughter sent me a text message with a picture of herself walking the dog on yet another snowy morning in Wrigleyville up there in Chicago. So, yeah, I'd rather it was a few degrees warmer, but we're not suffering anything like my friends up in the Northeast. Talking to some friends in Maryland, they're getting a 70-degree day followed by a 40-degree day, and it's just not a fun spring for them. Normally, I would make fun of them and send them pictures of our weather forecast, but, this weather's starting to impact the baseball season, and I'm not real happy about that. The Boston Red Sox-Baltimore Orioles game was canceled for today. Not happy about that. And we had 6 cancellations, I believe, on Saturday over the weekend due to inclement weather up in the northeastern cities. And come on, guys, I need to be watching some baseball down here. So let's get it together and warm up there. Anyway, the big news of the day is Syria. And the markets don't seem to care about it. It's kind of a one-off. Apparently, we really did warn the Russians we were going to do it, giving them time to move their troops and equipment. So we did not ignite World War III in the region. The markets don't care, and I'm not sure really what the motivation for this attack was, other than to look like we were doing something. The war in Syria, whatever side you choose to favor there, is pretty much over. Assad has regained control of most of the territory once held by rebels, certainly all of the major population centers. And Sunday they were right back to business as usual. They may not have been using chemical weapons, but so far over 400,000 people have been killed in Syria by conventional weapons, and they were right back to bombing cities and rebel strongholds again on Sunday morning. So there was no real change out of the bombing. I'm not quite sure what impact the Allies thought it would have, but I don't really think it accomplished much of anything. The markets don't care. The oil markets don't even seem to care about it, and they usually get a little jumpy about bombings in the Mideast. We'll see how that progresses. Hopefully, we're smart enough not to get too entangled in that. There's very little upside to the United States being involved in Syria, and a whole bunch of potential downside, including potential of triggering World War III with all the Russian troops in Syria. We can't fix everything in the world with our military, guys, and this might be one time where we need to pull back and say maybe, as a nation, we just stay out of this one. Okay, put the soapbox back away. Great editorial in the Wall Street Journal this morning by a gentleman named David Smick. He is in favor of something he calls baby bonds. If you haven't seen the paper yet this morning, get it just for this editorial. He proposes that in addition to the regular social welfare programs that we have, the U.S. Treasury put in place an equity account of, say, $5,000 for every baby born in the United States. And maybe you cut that off to every baby born to a non-millionaire in the United States. Not quite sure how you set that up or where you cut it off, but this is worth discussing. Equity index funds, maybe a global or U.S.-centric index, whatever it is, $5,000 principal to be paid back in 50 years out of the account. The money cannot be touched. It cannot be removed. It simply has to be allowed to compound over that child's lifetime in equity investments. That gives everybody an equity stake in America. Now, like it or not, most of the wealth created in this country is created by equity ownership, real estate ownership. It's by owning stuff, not by collecting income that you pay huge taxes on all the time. So this is actually a way of narrowing the wealth gap. It's a little more government intervention into life than I usually like to see, but it's not a bad idea. Now, by the way, Mr. Smith has written a book called The Great Equalizer, How Main Street Capitalism Can Close the Wealth Gap. I had not heard of it. I just ordered it. He also is the publisher of something called The International Economist, and I think I'm going to subscribe to that too. It's only $72 for a year, and it looked like pretty good exchange of some interesting economic planning ideas. So anyway, if you haven't seen the editorial, read it. Consider reading the book. It's supposed to be very well written, easy to read, lots of great ideas on how to use equity and capitalism to narrow the wealth gap. Much preferable means than socialism and excessive and internal government intervention. So I hope we see something like that because I really do believe that equity capital is the key to closing the wealth gap. And I'm very disappointed that not one U.S. corporation took advantage of what was a huge opportunity just handed to them by the Trump administration. I'm talking about, of course, the tax cuts. How cool would it have been? 43% of the money saved by tax cuts, billions of dollars, is going to be used to buy back stock and pay dividends. How cool would it have been to see one of those companies, just one, be smart enough? And I thought of it, so it's not rocket science, to have done a big stock buyback, but then instead of retiring the stock, distribute it to non-manager level employees and giving everybody in that company equity, skin in the game, a stake that can grow over time and build their wealth. And again, maybe narrow that massive wealth gap between executive officers, CEOs of the companies, and the workforce, which, by the way, is at one of the highest levels it's been in our entire history. It'd be great to see that narrowed. Equity capital is a cool way to do it. But anyway, just tossing some ideas around a lot because then not a lot to talk about on the small bank front. We don't start to see our earnings for a couple more weeks now, and the Dodd-Frank repeal and change legislation is still working its way through Congress. We don't have a compromise bill yet, so sitting here and debating whether we like the Senate bill or the House bill, it's a waste of our time because the bill that comes out is going to contain elements of both, and we really don't know which elements of which bill will go into the final compromise bill that will then hopefully be sent on to the president for signature. We are pretty sure there'll be some regulatory relief and rollback for smaller community banks, and that's going to be another huge plus along with tax reform that should help drive our smaller stocks higher over the course of 2018. We did see the three of the big banks report, and their reports were good. They were not spectacular. Wall Street didn't like them. I don't really care because I don't own them. I have no intention of ever owning them unless we see some cataclysmic event that makes them unusually cheap. But even then, the small banks would be cheaper still and a better bargain. So not much chance of me ever owning the big banks, but they do control the bulk of the deposits and the loans in the U.S. banking system. So I read the reports, and the CEOs of two of the three were pretty upbeat. Wells Fargo CEO, they're still beleaguered. They're looking at a possible $1 billion settlement with the federal government because they got caught what everybody else has been doing all along, but they're kind of the bag holder of this go round. So all Wells can talk about is the regulatory and internal problems, and their calls are not a very useful source of information. JP Morgan and Citi, solid credit conditions. Some people jumped on oh my goodness, the credit card loan losses have gone up 8%. Yeah, they did. But it's starting from such a low level that it's not a serious threat to any of the portfolios. Credit cards are only about 10% of the overall business. They're charging 20% interest rates on it. So an 8% increase in the charge-off rate there is just not a concern. We're watching it like we do auto loans because that's where the trouble shows up. So far, credit losses are growing a little bit, but not enough to concern us or give us broader economic concerns at this point in time. Speaking of economic concerns, we had some Fed speeches last week. We've got 3 of them this week. That should be entertaining. These guys have all slipped the leash when we'll be speaking around the country. And kind of read between the lines in their remarks, particularly in Jerome Powell's speech in Chicago, the economy may be performing at a level that leads to more interest rate increases than the market currently expecting. Remember, KKR is calling for 6 and Guggenheim's calling for 8 in 2018 and 2019. That would be a heavy headwind for the market to overcome. That would get overnight rates back up into the 3.5% area. That could be a problem for corporate cash flows, possibly even triggering some increased default rates in the high yield bond market. So that's been one of our dangers to the market. We see geopolitics and interest rates going up faster than the market expects as threats to the overall market. Not sure it hurts us as small bank stock investors because higher rates mean higher net interest margins, and higher rates also mean the economy is growing well, which means collateral values are staying firm, and we're seeing increased loan demand and increased deposits. So that kind of pushes our earnings higher, making some of our banks an even more attractive M&A target. So we pretty much remain in a win-win buy situation. If things remain as they are with 2% growth, low interest rates going up very gradually. Fantastic. We're going to see lots of M&A. Small banks will continue to outperform on both loan quality and earnings. And as I said, we'll see increased M&A as the only way to attain double-digit growth will in fact be to buy it. We'll see a lot of smaller regionals buying our community banks, and we'll be happy to sell them to them at the right price. So the other win situation is we get accelerated growth, higher rates. We're going to see much higher earnings, particularly we've got tax reform. We get some regulatory relief. We've got a faster growing economy. Our earnings are going to grow very rapidly for our small banks. That's going to take our stock prices higher. That's a win. The third scenario, that's buy. That's where we go up too fast. We tip the economy back into a recession. The market responds very negatively to geopolitical events, and we see, maybe not as bad as 2008, 2009, but a falling, rapidly declining stock market. We call that buy, okay, because our banks are going to go down, not as much as the broader market, i.e., in my opinion, but they will go down some. So we'll feel some short-term pain, but from a long-term opportunity, that universe of very attractive, well-run small banks trading over book value will get a lot bigger, so we can put some of our cash to work. We've got a tail hedge in place in the main portfolio. We have lots of cash in the banking on profit portfolio. And those of you that have the focus stocks in the Community Bank Stock Investor, the monthly version of our publication, we do recommend that you look to hedge your overall risk, especially on days when volatility is low and insurance is cheap, and that you hold a lot of cash, because buy is one of the three possible scenarios. I weight them all about an equal probability at this point. So keep yourself set up for win-win buy. Hold lots of cash in the portfolio. If it does go down, be an aggressive buyer of small bank stocks. So, okay, moving on, we've got the new Community Bank Stock Investor. I just got that all put together over the weekend. It's gone off to the production folks up there in Detroit. Hopefully they were able to cross the frozen tundra and get into work this morning. We can get that out to you either later this afternoon or tomorrow afternoon at the latest. You should have that. We've got a couple of great new focus picks in there of micro-cap banks that I think you're really going to like. But moving on, baseball. The Orioles are they're about what I thought. The pitching's a little bit better than we'd hope, but nobody's hitting. It's just at this point in time, not a very good baseball team. If they don't start hitting the ball here real quick, they are not going to contend for the third place finish that I was hoping to see. They're seriously challenging the depleted Tampa Bay Rays for last place in the American League East, and I really don't want to see that. We'll see how it all plays out over the year. Been some surprises. Some of the northern teams are struggling with the weather. The Pittsburgh Pirates are ignoring the weather. They are off to a fantastic start. So are the New York Mets, the Boston Red Sox. Apparently they're determined to let the Yankees and the Nationals know that they are not going quietly into that good night. And of course, Shohei Ohtani, what can you say? After spring training, I wasn't sure about this guy, but he is the real deal. He's hitting. He has an ERA around 2. His start yesterday was delayed by weather, so we should see him pitching later this week. But he has been everything as promised and then some. Very exciting. I expect to lose a lot of sleep this year watching Los Angeles Angels games. Late baseball. No, games don't start out there till 10 o'clock, so I'll lose some sleep, and my wife will yell at me quite a bit, but I'll get to watch the guy play baseball along with Mike Trout. That's a 2-for-1 punch you really can't turn down if you're a baseball fan. Now, on the book front, just started Isaacson's Ben Franklin. This is a fantastic autobiography of one of the more interesting characters in American history. It's a very large book, very weighty tome, so it's also useful for insect swatting and disciplining small children if it comes to that. But I've worked my way through about a third of the book rather rapidly. I'm looking forward to it because it's very well written, and Franklin is just one of the most interesting people in all of history, in my opinion. If you've never read it, I highly recommend it. Now, coming up this week, we have Christopher Moore's new book is coming out this week. Cannot wait. He is one of the funniest writers that I've ever read. His new book is called Noir. Can't wait. Have it pre-ordered. The Kindle edition is not coming out till October for some strange reason, but I ordered the hardback, and I think that should be here tomorrow. If you've never read Moore, treat yourself. It's worth doing. Then go into his back catalog and read those in order because they are roll on the floor funny. So if you're in a bad mood, buy the book. Lots of stuff coming out. New Alex Hawk book by Ted Bell will be out this week. I'll also be jumping right on that one. And I have a new Jeffrey Deaver loaded on my Kindle that I actually can't wait to read. And again, all the rest of my stuff is on goodreads.com because I read a lot of just kind of relaxation fiction, and everything I finished in the last week in my ratings can be found by following me on goodreads.com. So anyway, that's the week in a wrap. We start seeing the regional and small bank earnings over the next several weeks. I look for more of the same. Tax reform will start to show up on the bottom line. We won't have the tax asset rollbacks that we had in the first quarter. So you should see a little stronger earnings growth. Loan demand should be good. And I think credit quality will remain exceptional. Credit cards, remember, smaller banks had to go after lesser credits in the credit card market. They could not compete with the larger banks as far as offering bells and whistles. So we may see some things in the credit card accounts, but on balance, I think it'll be pretty healthy. So anyway, excuse me. That's all I have from down here in Central Florida today. If you're up north, stay warm, and I'll talk to you guys next.